Worst habits in trading. Introduction. However, this way of acting, cannot completely take away the damaging habits of trading, which are contrary to our nature. We are constantly subjected to feelings and emotions in life, more than most other activities in which we decide to engage, and this factor can also seriously interfere in one of the most profitable activities in the world that exists nowadays, even in a strongly technological and computerized environment, like with the trading activity. Trading is an activity that we usually practice on our own, and this can possibly lead to the development of harmful habits in trading, which can impede our process of making money in the stock exchange. If you participate in any kind of online trading room, you will not only be receiving valuable information, but also you will be able to talk and exchange ideas with other people who are already reaching their objective in trading. You should also make the necessary effort to follow as many kinds of educational material referring to the stock exchange, like reading many trading books, listening to trading audiobooks, as well as reading daily the necessary financial information contained within the newspapers. Furthermore, you should write about the newspaper and as many as possible analyses whenever you make a trading operation in order to track your steps, that is to say, to understand where you have slipped. The trend of trading is to keep in motion while avoiding as many obstacles as possible. So, for traders, bad habits do not merely get in the way of success, but instead are something that the trader does to end any hope of winning. Bad habits are usually considered undesirable by those in the habit of trading, at least if they have taken stock of those habits. Traders cannot be unaware of their bad habits. They cannot practice self deception when they are there to see it. Bad habits of trading are just those underlying constant tiny little choices to do things that take the trader apart at the very time the trader wants themselves to be in one complete piece. Traders simply need to stop choosing bad habits and instead choose good ones. Trading is almost bound to be very difficult in many respects, but in many other respects it is incredibly simple. No bad habits. It is just so easy. Most elements of trading are simply a matter of not doing a laundry list of bad habits. What you have left to do in wanting to dispose of these bad habits is to take up some good habits. Choose good habits. Choose them at the expense of the bad habits. What are the worst habits that traders have? There are many lists of these worst habits, and many could be added. It is difficult to put these habits in some kind of order, but they may well be considered the worst, and doing just a few of any of them can really get you into trouble. You can, without doubt, add some of your own favorite habits that should also be on the list. It seems that trading is a magnet for bad habits, perhaps not so much in establishing these habits, but in being unable to break them. It can often seem as if traders get pleasure from breaking these habits more than in trading itself. They are often contrary to proficient trading practices, yet people cling to them, while somehow expecting practicing those other things will limit the damage the habits cause. Yet they do not need to be cultivated. They do not just get picked up by swimming in the trading ocean. They are choices that people make. You can instead choose not to develop these bad habits in the first place. But first, the habitual new trader needs to see that there are some attractive, viable alternative habits. These alternative habits should be implemented as consistent rituals to supplement and replace the detrimental patterns that hinder the effectiveness and success of trading activities. Firstly, consider establishing a morning routine that sets a positive tone for the day's trades. Engaging in meditation or mindfulness practices can help cultivate a calm and focused mindset, allowing you to navigate the market with clarity and composure. Additionally, incorporating regular exercise into your daily regimen not only promotes physical well-being, but also enhances mental acuity and reduces stress levels, thereby improving decision-making abilities during trading. Furthermore, it is crucial to prioritize continuous learning and self-improvement as an intrinsic part of your trading journey. Explore various educational resources, both theoretical and practical, to expand your knowledge and hone your skills. Engage in online courses and webinars, attend workshops, and seek out mentorship opportunities to gain insights from seasoned professionals in the industry. Additionally, stay up to date with current market trends and news by subscribing to reputable financial publications, following influential traders on social media, and regularly analyzing relevant data and reports. In order to reinforce positive trading habits, consider keeping a detailed trading journal to track your activities, strategies, and outcomes. This practice not only aids in self reflection and improvement, but it also allows for the identification of patterns and areas for growth. Regularly reviewing your journal entries enables you to make more informed decisions and avoid repeating past mistakes. Additionally, fostering a strong support network of like minded individuals can greatly contribute to your trading success. Engage with fellow traders through forums, online communities, or local meetups to share experiences, exchange ideas, and gain valuable insights. Collaborating with others and learning from their successes and failures can provide fresh perspectives and inspire innovation in your own trading approach. Ultimately, aspiring traders must embrace discipline and self control as fundamental habits to cultivate. Develop a robust trading plan with clear entry and exit strategies, risk management techniques, and specific targets. Adhere to your plan diligently and resist emotional impulses that may lead to impulsive and irrational trading decisions. Implementing strict risk management protocols, such as setting stop loss orders and allocating reasonable position sizes, can help protect your capital and mitigate potential losses in volatile markets. Remember, success in trading is not determined by chance or luck alone. It is the result of consistent effort, continuous learning, and the cultivation of positive habits. By undertaking a deliberate and systematic approach to your trading activities, you can overcome detrimental habits and propel yourself towards greater profitability and long term success in the stock exchange. Choose to prioritize good habits over bad habits and unlock your full potential as a skillful and prosperous trader. Chapter 1: Common Mistakes in Trading. Formal studies suggest that investor overconfidence statistically corresponds to higher trading turnover, even when self admitted difficulty in making decisions is taken into account. This tendency towards increased levels of trading, essentially a more aggressive strategy, has a significant influence on individual stock returns. Overconfident investors tend to trade more in small and high volatility stocks. Many traders are unable to admit losses and let the market take away more than they wanted to lose. These Hungarian investors hold on to losing investments for too long, disregarding the proverb freeze or flee. This results in great losses on their part. Many young and inexperienced stock traders enter the market with great enthusiasm, full of excitement about its prospects, and with expectations of easy profits. Only a few of them are able to make a consistent living from trading, and most wash out in a very short time, often quitting the profession in frustration and after having suffered heavy losses. What went wrong? Why is trading, assumed to be a surefire way to get rich quick, much more difficult than anticipated? What are the most crucial pitfalls which stock traders, especially the inexperienced ones, repeatedly fall into? The worst habit among stock traders of every stripe is overtrading, buying and selling much more often than is recommended as profitable. Books from the field of financial market psychology usually do not deliver valuable pieces of advice to black traders. Typical advice comprises: stop investing and issue the financial markets that are responsible for all your losses, as this is the easiest action you can take. Tolstoy starts his novel Anna Karenina with "All happy families are happy in the same way, while every unhappy family is unhappy in its own way." I notice an astonishing coincidence in predicting, defining, and diagnosing toxic trading habits in much the same way. It does not signify that the amount of these habits is limited. I petitioned my mentors for pardon for my synthetic, generalizing evaluation model, as it may be taken as too simple. Keep in mind that everything that is simple is wrong. In this chapter, I would like to tell you who should read this book and what purposes it serves. I concentrated on operational rules used by market players. The content of the book was initially too large to put it in just one volume. Therefore, I have made the decision to isolate these rules and among them, choose those which are the most toxic. The applied method rationalizes the selection of toxic rules as they are detrimental to successful trading. Although I got to know some of the described cases, the great majority of them were prepared by people trading financial markets. And I would like you to know from which mistakes my students and your colleagues have had to suffer and endure. Expanding the text, formal studies suggest that investor overconfidence statistically corresponds to higher trading turnover, even when self admitted difficulty in making decisions is taken into account. This tendency towards increased levels of trading, essentially a more aggressive strategy, has a significant influence on individual stock returns. Overconfident investors tend to trade more frequently in small and high volatility stocks, often hoping to make quick profits. This behavior, fueled by their overconfidence, can lead to excessive buying and selling, contributing to higher trading turnover. Many traders are unable to admit losses and let the market take away more than they initially intended to lose. These Hungarian investors, in particular, have a habit of holding on to losing investments for extended periods, disregarding the proverb freeze or flee. Unfortunately, this stubbornness results in substantial financial losses on their part, and they fail to recognize the importance of cutting their losses and moving on to more promising opportunities. It is not uncommon for young and inexperienced stock traders to enter the market with great enthusiasm, fueled by the allure of potential profits and the excitement surrounding trading. However, the reality is that only a small fraction of them are able to sustain a consistent living from trading, while the majority end up quitting the profession in frustration after experiencing heavy losses. This begs the question, what went wrong? Why is trading, which is often assumed to be a surefire way to get rich quick, much more difficult and challenging than anticipated? Inexperienced stock traders consistently fall into various pitfalls that can hinder their success in the market. One of the most detrimental habits among traders, regardless of their level of expertise, is overtrading. Overtrading refers to the excessive buying and selling of stocks far beyond what is recommended as profitable or necessary. This behavior stems from the misconception that more trades equate to higher profits, but in reality, it often leads to unnecessary transaction costs and reduced overall returns. When it comes to seeking advice on financial market psychology, books often fail to provide valuable insights for traders. Instead, they may simply suggest that traders stop investing altogether and blame the financial markets for their losses. This superficial advice fails to address the underlying psychological factors and decision-making processes that contribute to trading success or failure. In relation to this, a quote from Tolstoy's novel, Anna Karenina, comes to mind. All happy families are happy in the same way, while every unhappy family is unhappy in its own way. Interestingly, we can draw a parallel between predicting, defining, and diagnosing toxic trading habits and the complexity of unhappy families. This does not imply that the number of these habits is limited, but rather highlights the multifaceted nature of detrimental behaviors in trading. It is essential to recognize the nuances and intricacies involved in assessing and addressing these habits, rather than oversimplifying the evaluation process. In this chapter, it is important to clarify the intended audience for this book and the purposes it serves. The focus is on operational rules used by market players, encompassing a wide range of strategies, techniques, and best practices. While the content of the book initially exceeded the capacity of a single volume, I made the conscious decision to isolate and highlight the most significant and toxic rules that can pose a threat to successful trading. By doing so, the book aims to rationalize the selection of detrimental rules and provide insights into their negative impact on trading outcomes. Throughout the book, you will come across various cases and anecdotes that illustrate the consequences of these toxic trading habits. While some of these examples are based on my personal experiences, the majority are derived from real-life stories shared by individuals who have been actively trading in financial markets. It is crucial to learn from the mistakes and challenges faced by both my students and your colleagues, as these firsthand experiences shed light on the realities and pitfalls of stock trading. Understanding these insights can help aspiring traders navigate the complexities of the market more effectively and make informed decisions with a greater likelihood of success. Chapter 2: Lack of discipline. Of course, discipline is key in the likelihood that good money can be made through trading. Inability to follow instructions is tantamount to the fact that the specific trading system would fail. As a result, risk management brings in the possibility of avoiding a loss. Lack of discipline also means that when there is a loss, a trade cannot use all money management mechanisms that can harness profit. These include not scaling down on the specific amount used to make a trade and not increasing the specific amount that can be used with a profitable trade. In general, it can be stated that if funds are already lost through lack of discipline, risk management systems do not work, and the ability of increased funds to make it into a profitable trade does not work. For constant profit, a steady trading behavior must be maintained. Keen adherence to a certain set of trading rules is the most open secret in trading. In life, individual disciplines are needed in order to adhere to a specific direction generally agreed to be a standard requirement for progress. Most traders lack discipline, and as a result, they do not see progress. Without discipline, trading would be a profitless venture for an individual. How does lack of discipline affect trading? Without discipline, a trade does not get to follow through their trading plans, such as stop, follow, and take profit. This means that capital can be lost as the trend moves against you, but lack of discipline makes it impossible to stop loss. Then, follow through also means increasing the chance of making profit by a trader. This means that trading could result in losses and a decreased chance in making good money through a trade. Emotions also tend to dominate a trade in the sense that a trade would lack the capacity to control their desires to increase the rate of profit, thus lacking the wiggle room that a trader needs for a trade to develop into money spinning. Newbies especially feel the need to get their share of the pie. Some even get the idea that trading is fun and easy, and they end up spending their entire weekend staring at charts, making impulse trades. After entering an impulse trade and expecting to make a fortune during the weekend, they immediately have to set a stop just below where they entered. Eventually, the market makes some moves and gives rise to a pullback and hits the stops for a loss. Then they may want to compensate ASAP, so they make another impulse trade, which eventually leads to another impulse counter-trend trade. Before they know it, they are already in a massive account drawdown, and the real value of their large live account has taken a massive hit. If you have ever entered a trade just because your current trade is doing well, or in a way of making up for past losses, then you are impulse trading, period. There are a lot of mistakes regularly made by Forex traders, and these are the most common, but also the worst causes of losing capital. In Forex, there's no way to avoid some common mistakes, and they simply come with excessive time spent staring at charts, which can inevitably cause a type of brain damage. It is always good to learn from other traders' mistakes and experiences, but it is definitely better to learn from your own. Whether a novice trader or an experienced trader, always research and be aware of the following worst habits in Forex trading for positive self-development and continued trading success. Just always try to improve your trading skills. The common plan most traders fail to follow is some loose framework of general help and wayfinding that in no way reinforces any sense of learning or truly learning from your methodology and reliably repeating productive trades, purging and correcting tendencies that do not work optimally. In short, most trading plans are empty but stripped of foundational, basic trading facts and problem-solving processes. Most of these traders live in a world of indicators, analysis, debate, and criticism, truths so very far from one another. All too often, traders are enticed and experted into a fishing expedition, looking for taped-on free lunches and nothing to learn from. A tagging along of esoteric, if exotic wisdoms, and a mishmash of refundable and forward-looking methods squished together using today's star ingredient that could have their chains yanked or be outlandishly debunked and renounced in a moment's notice. Very simply, a trading plan is your rule book. It is the common knowledge, protocol, and rules that you have tested and believe are useful in finding trading opportunities and deciding which to take. It is day to day, minute to minute instruction on methods, protocols for evaluating risk, position size, stop placement, and exit strategies, or protocols. It is the trader's survival guide. It is also muscle memory to follow and consistently apply and make decisions under varying pressures and time constraints, especially in moments of doubt and panic. A plan works with your personality if you did the foundational work correctly. It is not some computer program, rather, it's the same decision making engine you employed when you arrive at different traffic configurations in your daily commute. The well structured plan has built in self correcting mechanisms as well as an opportunity to grow in personal understanding of both the market's idiosyncrasies and your own biases and blind spots, tendencies, and impulses. The true thing to do and takes a lot of practice and experience is nothing. The only thing to do after starting the trade is sit by and let it play out. Of course, this doesn't mean to not be aware and keep tabs on the proximity to your stop and key levels, but altering the plan just to feel right is foolishness. I find a similar lesson in golf. You must select a club, then stick to that decision with conviction and not change until time is put back into these calm decisions. We can learn to react calmer, obviously, due to experience. But I always am drawn back to the conundrum of how we as humans can remove this emotional hesitation when faced with this stressful situation. There is an onslaught of emotions caused by losing money, making money, having winning or losing trades, just to name a few examples. Being able to stay level headed and make both buy and sell decisions while not emotional is a very large factor in good trading. Of course, this is no easy task, as our brains have been hardwired from a young age to default to our emotions for decisions. There is also a correlation between people and this brain wiring to always want to be right and call tops and bottoms all the time. A professional's brain has been programmed to act differently than this. The main logic we try to adhere to is the market is king. The stock can close above your level X or below your level Y. You cannot let that shake you out of a trade if that was not your predetermined plan. Chapter 3. Overtrading. A frequent psychological reason for overtrading is a person striving to feel intense emotions, whether they are positive or negative. It is this extreme stress during decision making in the trading process that always leads to financial losses of a trader. Outbursts of emotions considerably reduce the efficiency of human activity. Tension usually results in irrational decisions, increasing the probability of erroneous actions. The incalculability of any financial market forces traders to make decisions without being 100% sure of the correctness of their chosen strategy. Any person will feel the fear of losing their assets at the time when they are not guaranteed anything. Therefore, it is critical for a trader to take control over one's emotions, develop psychological tolerance, and learn to contain their greed and to have clairvoyance over their fear. Often, positive feedback from traders' trades leads to greed for more profit and therefore makes trade more often. Such an approach to trading usually leads to financial losses of a trader, although if there were no overtrading, the investor could achieve significant results. It is very hard to recognize situations when a trader is overtrading, and therefore it is necessary to have clear criteria that would help the traders to identify the signs of excessive excitement, depending on trading style. Any trading style always has its weaknesses, which should be minimized in order to maximize the safety of trading. For Thurl and Vint, 2001, supports some fundamental principles explaining this situation. The first of them is related to the issue of psychological, namely, when people are induced to make decisions, they are often led by emotions, which leads to irrational decisions. In the case of the stock market, when a certain bullish or bearish trend emerges, entities try to anticipate the movement of these trends and follow up on them, making the prices move away from the corresponding technical indicators. In addition to this, new technology has led movement's instrumental investors to seek an advantage over the market, and to do so, in some cases, they ignore the use of some fundamental principles. Another fundamental principle that involves the chasing activity is the adhesion to a positive feedback system, where many investors who follow a trend end up creating the same consequences, leading to an increase in the probability at shorter or longer intervals, causing the market to move around this trend. This also occurs when investors seek to behave in the opposite direction of the trend, setting up a negative feedback system. This declaration is especially evident when the market is in a news cycle, where the speculation leads to significant market moves against the general trend. At this moment, economic and political aspects are the main causes bringing turbulence to various markets, due to the fact that any decision or statement taken by relevant actors can bring oscillations to the markets. In this way, through the technique of consecutive purchases, many investors can buy shares at the peak of the market. Prices move away from the moving averages that have good interpretation in the statistical context, and even correlations between shares and assets are jeopardized. If you want to be a successful trader, you need to always get your facts straight. The best way to do that is just to ignore rumors, period. There is no replacement for true research and accurate fundamental analyses. Remember, Warren is synonymous with fundamental analysis. So again, I reiterate, what works for Warren doesn't work for all of us. Trading based on rumors is only one step above outright gambling. Yes, we realize that Warren Buffett is known to hedge his shorts by spreading rumors every once in a while. And let's face it, he knows how to throw them. He even hyped rumors about having to pledge his Berkshire Hathaway holdings to cover the losses of long-term capital management. In the grand scheme of things, that doesn't really do a whole lot to drive stock prices. Plus, what works for Warren doesn't work for the rest of us. This probably goes without saying, but rumors should never influence your trading decisions. When traders get bored, they start talking about everything, including rumors. So you are inevitably going to hear some things, and we hope you always remember that it is nothing more than speculation and never influences your actions. A frequent psychological reason for overtrading is a person striving to feel intense emotions, whether they are positive or negative. It is this extreme stress during decision-making in the trading process that always leads to financial losses of a trader. Outbursts of emotions considerably reduce the efficiency of human activity. Tension usually results in irrational decisions, increasing the probability of erroneous actions. The incalculability of any financial market forces traders to make decisions without being 100% sure of the correctness of their chosen strategy. Any person will feel the fear of losing their assets at the time when they are not guaranteed anything. Therefore, it is critical for a trader to take control over one's emotions, develop psychological tolerance, and learn to contain their greed and to have clairvoyance over their fear. Often, positive feedback from traders' trades leads to greed for more profit and therefore makes trade more often. Such an approach to trading usually leads to financial losses of a trader, although if there were no overtrading, the investor could achieve significant results. It is very hard to recognize situations when a trader is overtrading, and therefore it is necessary to have clear criteria that would help the traders to identify the signs of excessive excitement, depending on trading style. Any trading style always has its weaknesses, which should be minimized in order to maximize the safety of trading. For Thurl and Vint, 2001, supports some fundamental principles explaining this situation. The first of them is related to the issue of psychological, namely, when people are induced to make decisions, they are often led by emotions, which leads to irrational decisions. In the case of the stock market, when a certain bullish or bearish trend emerges, entities try to anticipate the movement of these trends and follow up on them, making the prices move away from the corresponding technical indicators. In addition to this, new technology has led movements instrumental investors to seek an advantage over the market, and to do so, in some cases, they ignore the use of some fundamental principles. Another fundamental principle that involves the chasing activity is the adhesion to a positive feedback system, where many investors who follow a trend end up creating the same consequences, leading to an increase in the probability at shorter or longer intervals, causing the market to move around this trend. This also occurs when investors seek to behave in the opposite direction of the trend, setting up a negative feedback system. This declaration is especially evident when the market is in a news cycle, where the speculation leads to significant market moves against the general trend. At this moment, economic and political aspects are the main causes bringing turbulence to various markets, due to the fact that any decision or statement taken by relevant actors can bring oscillations to the markets. In this way, through the technique of consecutive purchases, many investors can buy shares at the peak of the market. Prices move away from the moving averages that have good interpretation in the statistical context, and even correlations between shares and assets are jeopardized. If you want to be a successful trader, you need to always get your facts straight. The best way to do that is just to ignore rumors, period. There is no replacement for true research and accurate fundamental analyses. Remember, Warren is synonymous with fundamental analysis. So again, I reiterate, what works for Warren doesn't work for all of us. Trading based on rumors is only one step above outright gambling. Yes, we realize that Warren Buffett is known to hedge his shorts by spreading rumors every once in a while. And let's face it, he knows how to throw them. He even hyped rumors about having to pledge his Berkshire Hathaway holdings to cover the losses of long-term capital management. In the grand scheme of things, that doesn't really do a whole lot to drive stock prices. Plus, what works for Warren doesn't work for the rest of us. This probably goes without saying, but rumors should never influence your trading decisions. When traders get bored, they start talking about everything, including rumors. So, you are inevitably going to hear some things, and we hope you always remember that it is nothing more than speculation and never influences your actions. A frequent psychological reason for overtrading is a person striving to feel intense emotions, whether they are positive or negative. It is this extreme stress during decision-making in the trading process that always leads to financial losses of a trader. Outbursts of emotions considerably reduce the efficiency of human activity. Tension usually results in irrational decisions, increasing the probability of erroneous actions. The incalculability of any financial market forces traders to make decisions without being 100% sure of the correctness of their chosen strategy. Any person will feel the fear of losing their assets at the time when they are not guaranteed anything. Therefore, it is critical for a trader to take control over one's emotions, develop psychological tolerance, and learn to contain their greed and to have clairvoyance over their fear. Often, positive feedback from traders' trades leads to greed for more profit and therefore makes trade more often. Such an approach to trading usually leads to financial losses of a trader, although if there were no overtrading, the investor could achieve significant results. It is very hard to recognize situations when a trader is overtrading, and therefore it is necessary to have clear criteria that would help the traders to identify the signs of excessive excitement, depending on trading style. Any trading style always has its weaknesses, which should be minimized in order to maximize the safety of trading. For Thurl and Vint, 2001, supports some fundamental principles explaining this situation. The first of them is related to the issue of psychological, namely, when people are induced to make decisions, they are often led by emotions, which leads to irrational decisions. In the case of the stock market, when a certain bullish or bearish trend emerges, entities try to anticipate the movement of these trends and follow up on them, making the prices move away from the corresponding technical indicators. In addition to this, new technology has led movements instrumental investors to seek an advantage over the market, and to do so, in some cases, they ignore the use of some fundamental principles. Another fundamental principle that involves the chasing activity is the adhesion to a positive feedback system, where many investors who follow a trend end up creating the same consequences, leading to an increase in the probability at shorter or longer intervals, causing the market to move around this trend. This also occurs when investors seek to behave in the opposite direction of the trend, setting up a negative feedback system. This declaration is especially evident when the market is in a news cycle, where the speculation leads to significant market moves against the general trend. At this moment, Economic and political aspects are the main causes bringing turbulence to various markets, due to the fact that any decision or statement taken by relevant actors can bring oscillations to the markets. In this way, through the technique of consecutive purchases, many investors can buy shares at the peak of the market. Prices move away from the moving averages that have good interpretation in the statistical context, and even correlations between shares and assets are jeopardized. If you want to be a successful trader, you need to always get your facts straight. The best way to do that is just to ignore rumors, period. There is no replacement for true research and accurate fundamental analyses. Remember, Warren is synonymous with fundamental analysis. So again, I reiterate, what works for Warren doesn't work for all of us. Trading based on rumors is only one step above outright gambling. Yes, we realize that Warren Buffett is known to hedge his shorts by spreading rumors every once in a while. And let's face it, he knows how to throw them. He even hyped rumors about having to pledge his Berkshire Hathaway holdings to cover the losses of long-term capital management. In the grand scheme of things, that doesn't really do a whole lot to drive stock prices. Plus, what works for Warren doesn't work for the rest of us. This probably goes without saying, but rumors should never influence your trading decisions. When traders get bored, they start talking about everything, including rumors. So, you are inevitably going to hear some things, and we hope you always remember that it is nothing more than speculation and never influences your actions. It is important to conduct thorough research and rely on accurate fundamental analyses when making trading decisions. Warren Buffett, a well-known figure in the investment world, is often associated with his profound understanding of fundamental analysis. However, it is crucial to acknowledge that what may work for Warren Buffett may not necessarily yield the same results for other traders. Placing trades based on rumors is a risky practice that is akin to gambling. Although it is true that Warren Buffett has occasionally utilized rumors to hedge his positions, it is essential to recognize the limited impact these rumors have on driving stock prices. Furthermore, as traders engage in conversations, rumors may inevitably be discussed. However, it is crucial to remember that rumors are mere speculations and should never influence one's trading decisions. Stay focused on factual information and reliable analysis to make informed and profitable trades. Chapter 4. Ignoring Risk Management. Order types and the type of market participant using the order type can be quite challenging for intraday traders to identify and comprehend. It requires a deep understanding and analysis to grasp the complexity of these order types. For instance, if a market participant enters a 400-lot offer in a specific market, it would not typically be the order type used for buying. Market participants generally exhibit a certain level of discomfort with market orders, which leads them to utilize more subtle and nuanced types of orders for purchasing securities. One such example is a limit order to buy placed below the current price. In this scenario, if the order does not get executed and remain outstanding, the limit order to buy remains in effect, without any physical transaction taking place. On the other hand, each cancellation, with certain exceptions, may be perceived as a fatal transaction. It is essential to consider that trends failing to print transactions suggest that the price indicator may not necessarily provide accurate information the majority of the time in the short run. Hence, it is always advisable to rely on human behavior rules in trading while engaging with market participants who exhibit a bullish sentiment towards assets. Numerous rules can be employed in this regard, as human behavior tends to remain relatively consistent across all markets. Ignoring risk management is one of the most prevalent and costly mistakes traders make. Many market participants solely focus on the potential rewards of a trade, often neglecting the crucial aspect of controlling the risk associated with it. These impulsive traders tend to rely on hope as their primary instrument for risk management, disregarding the importance of proper risk mitigation. Effective risk management serves as a defensive mechanism that assists in mitigating risks when unwanted market events occur. These unfavorable events frequently lead to poor trading outcomes, resulting in highly chaotic trading conditions. Prudent market participants understand that without adequately protected trading accounts, greed can potentially lead to devastating losses. Risk management encompasses the implementation of strict orders that reduce the visibility of the order flow, ensuring that specific order information remains concealed from other market participants. Safeguarding the welfare of one's trading account becomes the outcome of employing efficient risk management strategies. A significant number of individuals solely rely on stop orders to sell when the market experiences an upward trend and refrain from selling when the market fails to appreciate. This approach is inherently flawed and must be avoided at all costs. Interestingly, countless individuals often express regret at social gatherings, discussing how they failed to sell their stocks during the mining boom. When questioned, they admit that they did not even consider selling their assets. Using stop losses can effectively eliminate emotions from trading decisions and automate the process. By allowing stop losses to perform their intended function, one can identify when a trade no longer aligns with their expectations and promptly exit the market. A straightforward rule of thumb to consider is selling a stock if its value falls below the lowest point observed in the last 3 months, indicating a lack of positive sentiment. Failing to set stop losses appropriately is a completely avoidable mistake that leads to significant financial losses. The absence of proper stop losses subjects your investments to market volatility even while you are asleep. Unfortunately, numerous traders set stop losses but fail to adhere to them. Initially, setting a stop loss serves as an integral part of one's trading plan. However, plans can only be effective if followed diligently. Precious metals and mining stocks, in particular, are prone to overnight price manipulation that can wipe out traders who fail to utilize market orders during moments when sleep is essential. Neglecting to set adequate stop losses is an entirely avoidable reason for individuals to suffer significant financial setbacks. Resource management plays a crucial role in enabling individuals to exercise control over their assets. Since accurately predicting price movements is exceedingly challenging without substantial luck or insider information, resource management stands as the most effective approach to pursue. It is prudent to avoid consistently involving fungible assets in speculative activities and, instead, analyze, purchase, and manage each asset on an individual basis while ensuring appropriate actions are taken when necessary. The majority of traders in the regular mobile decentralized trader category, possessing the necessary resources and lacking severe custody issues, often suffer losses due to a lack of understanding regarding appropriate actions to take in various situations. It is a common habit among some individuals to purchase every available asset within a specific category, resulting in asset overexposure. Whether it be Bitcoin, Apple stock, or a commodity, speculating on a single asset while having well thought out reasons to do so is entirely possible. In fact, whenever an idea lacks clarity in a customer's mind, it is generally best to refrain from taking any action. However, the practice of indiscriminately buying every available asset to resell for profits, as popularized by some, may prove to be detrimental. Assets purchased solely due to their existence can drastically decline in value without warning when the factors that contributed to their inflated prices diminish. Owning several assets simultaneously remains a prominent strategy employed on Wall Street. The concept of predictive trading has always captivated traders as they strive to gain an edge in their trading strategies. Many traders claim that by successfully predicting market movements, they can generate profits consistently. However, it is vital to recognize that this edge cannot exist unless these traders possess a solid understanding of risk management, including the risk-reward ratio. The risk-reward ratio serves as the foundation of trading and demands respect from every trader. While debates regarding its significance continue among traders, it is worth noting that even with a trading strategy exhibiting a relatively low predictive rate, around 30%, a robust risk management plan can still yield profits. Conversely, even if a trading strategy boasts a high predictive rate of 70%, A weak risk management plan would ultimately result in financial losses for traders. Among all the topics discussed in this booklet, none holds more importance than the risk reward ratio. It embodies a fundamental truth that every trader should acknowledge and comprehend. This simple truth serves as the key to successful trading, yet it often remains neglected or overlooked. Your trading system and risk management plan should work in harmony to deliver profits in the form of returns on your investments. It is crucial to acknowledge that every trade carries a certain degree of risk. In every trade executed, potential risks are present, and effectively addressing and resolving this ongoing issue has raised questions and concerns across global markets. Chapter 5. Lack of patience. According to data from our system, traders' most frequent mistake is lack of patience. Instead of studying, gaining practical experience, and getting knowledgeable and structuring the idea of the market relying on the knowledge of those experienced traders who made it, we observe them simply buy and sell continuously. If we had put aside the mathematics and asked traders to explain how they trade, we would be convinced that most traders don't even consider sales and purchases are based on a logical sequence settled by a particular strategy, and not by the notion of the big player's hunch, current value of moving of the assets, and recent trading news without any transitions. Don't you understand what you are doing and are learning is the game of chance? Are you playing a video game? Then keep on clicking and buying with the hope to make a fortune. If you are not playing a game, then stop fidgeting. Take a thick book in philosophy and learn to approach the acquisition of knowledge from the general to the particular with Aristotle. Better yet, if you want to know how successful traders behave, read successful traders' biographies. Success of a good HFT trader, we assure you, is entirely different from success of a basic model of beginning traders. Most beginning traders are in a hurry. They think they need to make money right now, and so they trade very often, say from 20 to 100 times a month. By the way, if you are trading 100 times a month, an average of 5 times a day, you are at risk even if you dare not to risk more than 1 to 3% of your deposit every time. You had better read the previous section and repeat 100 times. Every bid is risk. Overtrading happens because of traders' attitude towards themselves and their trading strategies. When day trading, avoid jumping in and out of trades. Act on solid and precise entries and let reasoning prevail over feelings. Despite the intense urge to trade, practice patience and develop the right discipline when day trading. It helps maintain serenity and peace in the chaos that's trading. It's the only sane way of making money, especially when the rest of the world is caught up and swept away in the sea of madness and hype. Make the mind, soul, and water one. Then all these tremendous expert forces will play on your team. How many times have you entered into a trade with every penny you have, only to end up with just about nothing in a few minutes? Not once or twice, probably more. Some have entered into such opportunities a couple of times a day, thus ending up with nothing but frustration and renouncing trading. Money is very irresistible to ignore. The need to get it frequently and rapidly is high, that many would be quick to buy any idea that promises to make money. It's this excitement we have for trading, coupled with our desires of quick returns, that cause us to jump in and out of trades. Even the most disciplined traders experience this urge. Trapped into an untold truth, traders keep searching for info, forex brokers, trading strategies, and ways to make money, ignoring the simple truth that proper discipline and patience is the key to unlocking their trading dreams. The problem comes in two parts. Firstly, how bounded is the time value of the elementary P-point model? What is a reasonable expectation for when that element of time decay is colossally large? Secondly, how much empirically are probably more forecast errors from the analyst's first trade thesis or dilutions of supporting a new idea, the S-point, more common in the hours just after a new idea revelation? Since the vast majority of errors will be about some misestimation on P, this period right after a new unveiling of information is much more error-prone. So we have a connectivity problem between expected price change conditional on the revelation and the probability of analyst error. Fundamentalists know they should never argue with price. Why would someone deliberately buck a consensus of a market of millions of individuals? In the life sciences, we never see a 100% causal connection between a behavior and an event's outcome. Instead, individual actions are associated with levels of expected outcomes. We use the term prospective here, as we are only seeing connections that are in their early or potential stages. It could take as many as 40 or 50 similar experiences until we can statistically measure an impact outside of random variation. Impatience amid drawdowns. Quickly related to the stubbornness of drawdown levels would be your own inability to bear patiently that your account's losses suppress. Mental toughness and patience are qualities frequently lacking amidst retail traders. Nonetheless, the choppier is the equity curve of your strategy, typically the lesser the strategy's expectations on risk-adjusted returns. Long-term profits from your robot were never promised to you as the smooth upward sloping line on your account, yet probably that is what you have become expecting. During 1995 to 2005, a lot of British pension schemes had financed bond funds with demonstrative thick-skinned success. They never requested investors to mark profits of immediately over 10 years, and other bond strategies endured drawdowns as the normality upwards and downwards on the way, fighting high drawdown levels. An analogous issue to overtrading is being unable to bear high drawdown levels. The robot slash strategy was well tested and has delivered consistent profits. You have a large first losing month in the sound that draws down your own account. Early account blowup is the cause of more than a few trading robots. To have your own account's drawdown rate trigger and also spill over to your robot could be possible just for the sake of your robot's long-term profits. An appeal of robotic trading is a freedom that one might feel from having to manage separately the portfolio of your own. But then, for any trading model, drawdowns are completely inevitable, together with high water limit marks. The strategies with high drawdown rates can over the long term provide best returns, even with investments. In conclusion, it is crucial for traders to practice patience and discipline in their trading strategies. Relying on the knowledge and experience of successful traders instead of simply buying and selling continuously can lead to more successful outcomes. It is important to approach trading as a game of skill rather than chance, and to take the time to educate oneself through studying and gaining practical experience. Overtrading, impatience, and the desire for quick returns can often lead to poor decision-making and financial loss. By practicing patience, developing a solid strategy, and acting on reasoned entries, traders can navigate the chaotic world of trading with more peace and serenity. Additionally, it is important to recognize the inevitability of drawdowns and to develop the mental toughness to bear losses patiently. By maintaining a long-term perspective and understanding that drawdowns are a normal part of trading, traders can increase their chances of achieving consistent and sustainable profits in the long run. Chapter 6. Over-reliance on indicators. What's the problem? Just load up your favorite combination of indicators and let that be your guide while placing orders. Sounds easy, right? Well, using a ton seems so harmless. The more the better. Some of the most overused, over-relied on indicators include Bollinger Bands, RSI, Ichimoku Cloud, MACD, and SMAs. If not carefully worked into a strategy, these indicators, really any, can set you back financially. But since I saw the mnemonic red lighty bluish hysteres, I know they are a go. One example is the use of RSI over 70 to sell and under 40 to buy. These signals are late and produce low expectancy trades and overtrading. There is no doubt that these things work for some people, but for the overwhelming majority, they are simply visual junk that will not help a system in creating alpha. How to correct it? There is no shame in admitting that indicators can be a harmless part of any strategy. However, sticking with a proven indicator such as the 50-day 200-day cross or volume as a tool to avoid iffy signals and to validate others, like your thesis, will ultimately prove to be much more peso-friendly. Removing non-value-added indicators will allow the trader to remove a little noise and see in real time when opportunity may be presenting itself. Regular price checkups without the hindrance of 9 different lines of previous price will do wonders in improving a trader's overall success rate on positioning size, strategy, and overall trade management. One bothersome habit I've seen with those trying to make it solo is getting stopped out during a pullback just to watch the price move in a most favorable direction. That reacts inside any trader from time to time, but with the removal of a lot of negative indicators, these emotions can be remedied and slash or altogether avoided. Beginning trader loses because he avoids the news and reports, while the professional reads it and knows it is already in his charts. Because it is nearing a considered fair price, the professional will usually need to do something different that the beginner never thought of. What a shock it will be when that trader who thought he had it all figured out gets caught on the wrong side for a major move simply because he relied on old patterns he noticed from his chart work. It is a beginner trading mistake to believe that you should avoid news and reports because it is already in the chart. However, it is an advanced trading mistake to rely on news and reports to make your trading decision. In actuality, if something is not in the chart, it will move the price away from a considered fair price. As prices continue to move, more people will start to buy and sell based on the newly forming trend until the price becomes fair, at which time the Wall Street prototypes will keep it at the fair price. Beginners will often try to make the excuse that they are cutting down on the variables to increase their profitability by eliminating subjective elements, but they ignore the fact that selecting these mechanical systems that outperform is how most successful professionals do better than the others. The black box trading system that only the author has the secret to will always make him the biggest profits, regardless of what you may have heard or read. It is tempting to believe that a trading system that uses technical analysis can give you untold profits. Professionals know that you should never blindly believe that technical analysis system indicators are secret keys to profits. In reality, professionals use these systems to help them select which trades. They analyze many variables that the system does not, including why a particular trade is taken. While you need to have a complete plan from entry to money management to exit, it is a big trading mistake to just follow these mechanical systems blindly. That said, fundamental analysis doesn't guarantee success. A basic subject related to practically all trading-related studies is the one of overconfidence in trading. And for the detriment of the likely earnings, a trader is expected to have a high confidence, an accepted idea of how a transaction could turn out. And if the traders who carry out fundamental analysis deduce that the transaction could benefit, then using only the available analysis method, considering basic analytical information, it would be natural for the trader to give up almost certainty that the position can benefit, and so they would not feel such a need to pursue additional trading methods. With all that and more in mind, one can only wonder how traders can think that by choosing to ignore fundamental analysis, they will benefit the trading outcome. There are quite a few methods of market analysis, such as technical analysis, sentiment analysis, order flow, and others. But fundamental analysis is the only type of analysis that focuses on a trader's ability to properly evaluate an asset. It is also the only analysis method that can work on its own. Fundamental analysis, like other analysis methods, is loaded with potential information. For instance, it could be summarized that an asset's intrinsic value in trade, return, risk, or any issue, such as the quantity of potential purchases in the market. Choosing to ignore fundamental analysis allows just one of these options. For others, you will have to rely on other trading positions. This is a largely missed opportunity. Chapter 6. Over-reliance on indicators. What's the problem? Just load up your favorite combination of indicators and let that be your guide while placing orders. Sounds easy, right? Well, using a ton seems so harmless. The more the better. Some of the most overused, over-relied on indicators include Bollinger Bands, RSI, Ichimoku Cloud, MACD, and SMAs. If not carefully worked into a strategy, these indicators, really any, can set you back financially. But since I saw the mnemonic red lighty bluish hysteria, I know they are a go. One example is the use of RSI over 70 to sell and under 40 to buy. These signals are late and produce low expectancy trades and overtrading. There is no doubt that these things work for some people, but for the overwhelming majority, they are simply visual junk that will not help a system in creating alpha. How to correct it? There is no shame in admitting that indicators can be a harmless part of any strategy. However, sticking with a proven indicator such as the 50-day 200-day cross or volume as a tool to avoid iffy signals and to validate others, like your thesis, will ultimately prove to be much more peso-friendly. Removing non-value added indicators will allow the trader to remove a little noise and see in real time when opportunity may be presenting itself. Regular price checkups without the hindrance of 9 different lines of previous price will do wonders in improving a trader's overall success rate on positioning size, strategy, and overall trade management. One bothersome habit I've seen with those trying to make it solo is getting stopped out during a pullback just to watch the price move in a most favorable direction. That reacts inside any trader from time to time, but with the removal of a lot of negative indicators, these emotions can be remedied and slash or altogether avoided. Beginning trader loses because he avoids the news and reports, while the professional reads it and knows it is already in his charts. Because it is nearing a considered fair price, the professional will usually need to do something different that the beginner never thought of. What a shock it will be when that trader who thought he had it all figured out gets caught on the wrong side for a major move simply because he relied on old patterns he noticed from his chart work. It is a beginner trading mistake to believe that you should avoid news and reports because it is already in the chart. However, it is an advanced trading mistake to rely on news and reports to make your trading decision. In actuality, if something is not in the chart, it will move the price away from a considered fair price. As prices continue to move, more people will start to buy and sell based on the newly forming trend until the price becomes fair, at which time the Wall Street prototypes will keep it at the fair price. Beginners will often try to make the excuse that they are cutting down on the variables to increase their profitability by eliminating subjective elements, but they ignore the fact that selecting these mechanical systems that outperform is how most successful professionals do better than the others. The black box trading system that only the author has the secret to will always make him the biggest profits, regardless of what you may have heard or read. It is tempting to believe that a trading system that uses technical analysis can give you untold profits. Professionals know that you should never blindly believe that technical analysis system indicators are secret keys to profits. In reality, professionals use these systems to help them select which trades. They analyze many variables that the system does not, including why a particular trade is taken. While you need to have a complete plan from entry to money management to exit, it is a big trading mistake to just follow these mechanical systems blindly. Chapter 7. Failure to adapt to market conditions. It is often said that there are an infinite number of ways that the price of any market can move. The line between chaos and order is very thin, and hence the line between predicting and not predicting market movements can be made very thick. It is thus possible for successful trading to occur across a wide variety of methods. The caveat is these must be adaptable to changing market conditions. We all know it is easier to trade certain market conditions over others, but identifying exactly what these conditions are can pose difficulties for many traders of all levels of expertise. There is no doubt that trading is incredibly challenging and that navigating your way to consistent profitability is no easy feat. This article is intended to help traders locate areas where they may be struggling and to provide a little insight into what they can do about some of their trapping behaviors. As such, you should be on the lookout for worst habits that may be creeping into your routine. Such habits will significantly impair your ability to perform as a trader and likely lead to a very short-lived career as a participant in the capital markets. Not respecting the power of self-similar patterns and adapting one's methods to market conditions that result in more frequent and smaller bar fluctuations versus less frequent and larger bar fluctuations leads to problems with this very easy to implement methodology. So that was quite the rant. But what does this have to do with any market? Well, everything really. Try investing in the Russian ruble in 2014 and see how well its previous 5 years of data matches its current volatility. It's extremely important to adjust your strategies to the current market volatility, and that all boils down to the time period you use to craft your model. If the time period you use for your model is too large, it will simply fail to capture the current volatility. This can be fixed by using more advanced techniques like time-varying parameters, for instance. However, if you create your model using too small a time period, it will be too plagued by the noise to be effective. Regardless of the method you use to create the model, it's imperative that any successful trading strategy adapts to and is tested against the current market volatility. This is the earliest date when we have data for the stock market. In 1827, the stock market in the US was the Philadelphia Stock Exchange with 25 stocks. You know what the problem with having only 190 years of data is? It's almost comical how bad that is. The maximum drawdown in the stock market during this 190-year period was 90%. Do you know what the possible error is on even 90%? It's at minimum 5 times as big as what we've already experienced. We can't possibly hope to build an accurate model of the stock market in order to create effective trading strategies with just 100 years of data, let alone one that can predict a 90% decline. They're not even rare. If you were going to start a new business and someone said, "Hey, I have a time machine here," it will tell you the average monthly return for the stock market. How far in the future should I fast forward to get an accurate estimate? What would you say? The answer is not 50 years, it's not 100, it's not 200. I'd actually say 1,000 years. This is because even 100 years of data isn't long enough. Imagine 1,000 years ago. That's a very long time. But now fast forward 190 years to 1827 in the US. Discarding fundamental analysis or beliefs by questioning others' analysis without true evidence is not behavior. It's no reason to remain excessively bearish in a monetary crisis. On the other hand, there's no point in going long in a short trend just because it's a serious financial catastrophe. A trader must realize the fact that the forex exchange rates will invariably rise and fall and move as per the dominant market organization, and that the role is to trade with them, rather than get exhausted in trying to predict them and seeking to rationalize every move as per the overall economy, or a hawkish undertaking or a dovish opinion. Finally, the most important thing a trader can do to be in the game for long-term profit is to understand and participate in the predominant market trends. Not bothering with market trends or short-term trends too is one of the worst habits many currency traders can sometimes exhibit. Trading goes hand in hand with forex market trends and prevalent moves. It's very rare that the trader will find a fourth wave which obviates the acknowledged forex market trend. Chapter 8: Lack of Continuous Learning. A documented hope for those removed from the school of ignorance, according to John Bates, a successful trader, in his article 7 Habits of a Successful Trader, says, "The financial world is always changing. Even the most advanced investors and traders need to stay up to date and refresh their knowledge from time to time. This is a non-negotiable part of investing and trading, regardless of your style. Keep attending workshops and seminars, and stay well informed through media and online resources. You should never get too comfortable or complacent, or else you will fall behind. It is an open/broad secret to learn from other people's mistakes and become a better and more informed person, ready to not repeat the same. Those with knowledge become leaders, those without knowledge remain followers. No one was born to remain ignorant, but some were born more knowledgeable than others. One of the internet gurus has repeated that you become an average of 5 people you spend most of your time with. However, if you walk in the school of foolishness, sooner or later you become the fool. As the world of commerce is overtaken by advancements in technology via the internet, streaming, workshops, webinars, meetings, etc., the rate of knowledge transfer has made many who had a low IQ score but the right knowledge become successful in stock market trading, more so than many who have the best brains in the field of stock market. Traders who hold on to losers are not likely to unlock a professional trader. No person likes to admit a mistake, but if the person doesn't admit that they are wrong quickly and move their stops, they may need to stretch their financial constraints. The most qualified traders don't allow the market to move against them. When the market shows evidence that the trade is no longer sound, they kill their losers quickly. Successful traders are excited to take a loss and move on. The former Secretary of Defense, Donald Rumsfeld, gave us some gems towards which traders are able to hold as truths in the world of forex trading as well as in the world of war. Trading is mostly about predefining the risk parameters of a trade and then just falling into the groove of a plan. As with any endeavor, a trader with a plan will have a much better chance at achieving favorable results than one who doesn't have a plan. Forex trading could be particularly tricky because it is impossible to know with any certainty what the future holds for a currency pair. The market could be very unpredictable, but a person should conduct market research anyway to understand it better. The most important parameters for fundamental analysis are formal share counts, news reports, salaries and unemployment figures, inflation, futures market news, as well as anything else that may cause the currency pair exchange rate to vary. Traders who allow either the dictates of human nature to get the better of them or who don't have the discipline and attention to detail to conduct the plan of trade may find themselves in a situation similar to what meets traders who don't even attempt to develop a trade plan. Those who utilize too much leverage may find that their financial information quickly goes awry. Even if an individual has an honest trading strategy and can determine the direction of the market with fair accuracy, using too much leverage will, in the long term, equate to a losing trade when one of those possible market swings would look like a stop. Most people believe they have ADHD or some other form of ADD when they're telling you that they can't focus, but that's not the case. Most likely, they simply lack discipline. We don't mean that you're like a teenager with no regard for rules, kind of discipline. Instead, we mean the ability to keep yourself in control and guard against the dangers of foreign exchange trading. This should not be a surprise. Yes, that's why learning discipline and patience in forex trading, also mentioned in Part 7. They are both really that important to your future in trading. It may be a good idea to add the lack of discipline to that entry at the end of the trading sin. This sin goes hand in hand with our last one. Failing to analyze your past trades is the height of stupidity. Why? Because keeping a trading journal not only helps you improve as a forex trader, it also keeps your emotional health in check. Sometimes it's not the market or economic situation that caused you to lose money. In fact, 80 to 90% of losing trades can be attributed to trader error. By keeping track of all your trading activity, you'll be able to isolate mistakes and maintain a mental stop loss. If you never analyze your past trades, you will never learn from them. As Buddhists say, the night is darkest before the dawn. Learn from your mistakes and from what went well. That's the key to long-term success in forex trading. However, given the fact that most news sites are now paid, being updated with news for free remains a huge struggle. But with a free and simple tool like Google Alerts, newsletters and subscription websites can have free real-time news delivered to your email. The heads of currencies or financial markets are the ones that I follow. These are examples of alerts I've created using Google Alerts, oil price, Bitcoin, and DAX. If you're interested in doing this or getting more insight into trading, you can get a free online trading class at Online Trading Academy. As professionals have stated in some articles, commodity trading or investing becomes particularly dangerous. Even though I'm investing in commodities, I have always been in search of news on this page. Although trading, I felt compelled to completely shake my plan, strategy, and trading strategy just by looking at these commodities once. This does not apply to newspapers at the beginning of the day, at the opening of a magazine, at trade, and at the end of the day. Personally, I check the trades and analyze the information. While professional traders focus on the markets, many other traders forget about this critical factor. There are traders who are not technical, however. For example, many traders that actively learn support and resistance at Online Trading Academy focus on color. time of day or price, time, and point trading. Some students who have never taken a professional class look at economics with great interest. However, many traders neglect one aspect of trading, which is the news. In my trading and technical analysis, news is a significant element. Daily, there are real time news that influence trade. Traders need to stay updated with current news and events, as they can have a major impact on market movement and trading opportunities. By market news, it is important to emphasize that not all news is useful for trading. Traders should focus on news that is directly related to the markets they trade, such as economic indicators, central bank decisions, political events, and corporate earnings releases. It is crucial to analyze the news and understand how it may potentially impact the markets, as this can provide valuable insights into potential trading opportunities. In addition, traders should also pay attention to market sentiment and investor sentiment, as these factors can also influence market movement. Overall, staying informed and up to date with the latest news and events is an essential part of successful trading. Chapter 9: Inadequate Position Sizing. Improperly guarding your positions is closely related to overtrading. It involves not respecting your positions. 9 out of 10 times, this happens because you take on so much risk that a big loss is equivalent to your account. Basically, if you risk amounts that nearly wipe out your trading initiatives, psychologically, you are much more likely to do everything you can, even sabotage your trades to protect what's left. Guaranteeing your trades suggests a lack of trust in your methods and gives birth to the trader's cycle of doom. You see this in their absence of conviction and their apprehension to exit a losing position at the point at which they had previously predetermined. This behavior serves only to accelerate the inevitable, which is the depletion of trading resources. Moreover, when you fail to adequately protect your positions, you open yourself up to a cascade of negative consequences. Not only does it leave you vulnerable to market volatility and unexpected downturns, but it also undermines your ability to make disciplined and rational decisions. By neglecting to guard your positions properly, you are essentially exposing yourself to unnecessary risk and jeopardizing your overall trading success. In order to avoid falling into the trap of improperly guarding your positions, it is of utmost importance to prioritize effective risk management strategies. One of the most common mistakes that traders make is inadequate position sizing. This occurs when traders fail to accurately assess the appropriate amount of capital to allocate to each trade. Without proper position sizing, traders may find themselves over-leveraging and exposing their accounts to unnecessary risk. This can lead to disastrous consequences, as even a small adverse movement in the market can wipe out a significant portion of their gains. Therefore, it is essential to carefully calculate and determine the appropriate position size for each trade, taking into account factors such as risk tolerance, account size, and market conditions. By implementing a systematic and disciplined approach to position sizing, traders can greatly improve their chances of long-term success. Another common pitfall that traders often fall victim to is overtrading. Overtrading occurs when traders execute an excessive number of trades, often driven by the desire to make quick profits or to compensate for losses. This can be extremely detrimental to one's trading performance, as it increases the likelihood of making impulsive and irrational trading decisions. Moreover, overtrading can lead to emotional exhaustion and burnout, making it difficult for traders to maintain focus and discipline. To avoid falling into the trap of overtrading, it is crucial to adopt a patient and strategic approach to trading. Rather than chasing after every potential opportunity, traders should focus on high-quality setups that align with their trading strategies and risk management principles. By exercising patience and discipline, traders can avoid the detrimental effects of overtrading and increase their chances of long-term profitability. Additionally, it is important for traders to develop a strong psychological mindset in order to guard their positions effectively. Trading can be a highly emotional and mentally challenging endeavor, and it is essential for traders to cultivate the necessary mental resilience to navigate the ups and downs of the market. This includes maintaining a positive and optimistic outlook, managing fear and greed, and developing a strong sense of self-discipline. By building a solid foundation of psychological strength, traders can enhance their ability to make rational and objective trading decisions, even in the face of adversity. Furthermore, by implementing effective risk management techniques, such as setting appropriate stop loss orders and utilizing trailing stops, traders can further protect their positions and minimize potential losses. In conclusion, properly guarding your positions is an essential aspect of successful trading. By prioritizing effective risk management strategies, avoiding inadequate position sizing and overtrading, and developing a strong psychological mindset, traders can greatly improve their chances of achieving consistent profitability. It is crucial to approach trading with discipline, patience, and a comprehensive understanding of the risks involved. By doing so, traders can enhance their overall trading performance and protect their positions from unnecessary risk and volatility. Remember, guarding your positions is not just about protecting your capital, but also about safeguarding your long-term trading success. Conclusion: the professionals earn consistent overall profitability through disciplined and well-managed sufferings within every trade undertaking. The stress experienced in trading is particularly high since during times of market uncertainty, the nature and causes of events naturally become perplexing. To attain a profitable equality in trading gives you a rewarding direct relationship with your efforts, while repeating profitable performances points to a quality trading skill predisposed to long-term profitability within your trading activities. This predisposition is only determined and classified by a realistic comparison of repetitive profitable opportunities experienced through individual trading and money management outcome performances. Only from a realistic appraisal of both the profitable and non-profitable performances is there a justifiable analysis on your future-oriented edge for long-term profitability attainment, suppressing all pre-existing undesirable trading habits. The worst habits in trading are the enemy within, which is likely to impose damaging effects over your trading activity. By the awareness, control, and correction of these damage-causing behaviors, you eventually shift to a more productive and rewarding undertaking. In identifying and correcting such deviant trading habits, you eventually shift to a more productive and rewarding experience. These habits are largely regarded as obstacles to trading success, deterring you from advancing your overall growth and development as a trader. The identification, control, and eventual replacement of such behaviors would finally bring you to a more worthwhile trading experience while every so often translating to major profitability. Habits are said to be hard to kill, but with the right approach and education in mind, you can well become the trader within the broker's conference room, laureled for a major career breakthrough in trading development and profitability. If you found this content enriching and valuable, we would be deeply grateful if you could express your appreciation through liking and subscribing. Your support is incredibly meaningful and enables us to continue creating content that resonates with you. For those who think this is a great gift for yourself or for your loved ones, you can find the link in the description.